I'm Isaac Barco from Openwork Mortgages. We're going to take a look at Tracker Mortgage as a remortgage option. So, as a mortgage broker, this is something I help people with. So, let's get to it. The mortgage market itself is shifting. So, following several cuts to the Bank of England base rate, Tracker mortgages are once again on the radar for borrowers remortgaging in 2026. So, trackers themselves are becoming more appealing, but how do they stack up against other options? So this is why tracker mortgages do matter right now. A tracker mortgage mirrors the Bank of England base rate plus a fixed margin. So if rates fall, your monthly payments go down, and if rates rise, your payments can go up. That's different to a fixed rate mortgage where you pay the same amount each month for a set period. Typically, that's 2 or 5 years, although longer fixed terms are also available. So, with a tracker, when interest rates change, your mortgage rate changes too. And with expectations that rates could continue to decrease, a tracker mortgage may look attractive for some borrowers. In fact, Andrew Bailey, the governor of the Bank of England, recently told the House of Lords back in 2025 the Economic Affairs Committee that the path of interest rates is still downwards. Following the base rate cut in August of 2025, experts at that time predicted further cuts later in the year, and we did see that at the end of 2025. However, it's important to remember that future rate changes are not guaranteed. The governor has repeatedly said that any movement will need to be gradual and careful, and it depends on key factors like inflation, the performance of the UK economy, and any external geopolitical shocks. These are all difficult to predict, but for borrowers who have the means and the confidence to ride the ups and downs of future interest rates, tracker mortgages are becoming a serious consideration again. That said, fixed rate mortgages remain strong too. Fixed rates are still very competitive, and in some cases they can be more affordable than trackers, at least in the short term. So, according to Moneyfacts, average mortgage rates on both 2 and 5 year fixed rate products sit at around 5%, with some sub 4% rates available for qualified borrowers. Fixed rates offer predictable payments and peace of mind, which can be especially helpful when budgeting in uncertain times. You may not benefit immediately if interest rates drop, but you will always know exactly what you're paying. And for many borrowers, that certainty can be more valuable than any potential saving. So, which option might suit you best? You can choose to track a mortgage if you're comfortable with fluctuations and you want to benefit immediately from any further base rate cuts. Opting for a fixed rate mortgage if your priority is stability and know exactly what your mortgage will cost, regardless of rate movements. And it's also worth discussing whether discount variable options might suit your situation, especially if you're unsure how long you'll stay in your home. So, whatever you're considering, get advice before you decide. The right choice depends on your personal situation, your risk appetite, and your future plans. So, mortgage brokers can explain the differences clearly, help you weigh up the potential benefits of a tracker against the certainty of a fixed rate, and guide you towards a solution that fits your needs. So, if your fixed term is ending soon, we can help you compare your options and choose with confidence. So, you can book an appointment on our website or reach out via the contact details. And remember, your home may be repossessed if you do not keep up with payments on your mortgage. The content for this video was approved by the Openwork Partnership on the 4th of September 2025.